All right, let's talk about the audit endgame. Now, this isn't just about wrapping things up. This is the final, super intense stage of the investigation, and it happens after all the main fieldwork is supposedly done. This is where the true story of the financial year really gets pieced together. It's a pretty common thought. The auditors have been through all the numbers, they've tested the transactions. The finish line has got to be right there. So, is it really time to just sign on the dotted line? Well, as you can probably guess, the answer is a little more complex. Not even close, actually. This final phase, which we call completion and review, is where auditors have to pull together all the evidence. It's this whole process that involves looking at stuff that happened after the year end, taking another hard look at the company's overall health, and getting these really formal confirmations from management. So no, this is not a victory lap. It's the final, crucial assembly of the entire puzzle. Okay, so here's how we're going to break this all down. We're going to cover 5 key areas in our little investigation here. We'll start with a general overview of an audit's final chapter. Then we'll go hunting for clues in what I'm calling events after the bell. These are crucial facts that can pop up after the financial year is technically over. After that, we'll check the company's vital signs to see if the business is healthy. Then we'll dig into why getting it all in writing from management is so important. And finally, we'll see how the whole shebang comes together to form that final audit opinion. So our first clue comes from things that happen after the financial year has officially closed, but before that audit report is actually signed. These are called subsequent events, and trust me, they can have a massive impact on the story the financial statements are trying to tell. So what exactly is a subsequent event? Well, according to the official auditing standards, it's pretty much any event that happens in that window between the company's year-end date and the date the auditor actually signs their report. What's wild is that the auditor's responsibility can even stretch to things they find out after the report is already out there. The big takeaway here is that the investigation doesn't just stop because the calendar flips over. And this timeline just illustrates that point perfectly. See, between the year-end date and the signing of the report, the auditor is on active duty. That means they have to be proactively looking for these events. But after the report is signed, their role switches to passive duty. They don't have to keep digging, but if something significant comes to their attention, you bet they have to take action. Okay, so subsequent events basically fall into 2 categories. First, you've got adjusting events. These give you new information about a situation that was already brewing at the year end. A classic example is a big customer who is already in financial trouble at year end and then officially goes bankrupt in January. The financial statements must be changed for this. On the other side, you have non-adjusting events. These are totally new situations, like a fire that burns down a warehouse in February. These don't change the numbers on the balance sheet, but if they're a big deal, they have to be disclosed in the notes. Let's make this really clear with the Murray Co. case study. So they had a major customer who owed them over $200,000, and that customer went bankrupt right after the year end. Because the financial trouble already existed at the year end, it's an adjusting event. That $211,000 is now gone, and it has to be written off. Now, compare that to a fire that destroyed over $1 million of their inventory in February. The fire itself was a brand new thing that happened after the year end. That makes it a non-adjusting event. The company has to disclose this massive loss in the notes, but they don't go back and change the inventory number that was recorded on December 31st. See the difference? Okay, let's move on to our next big clue. It's not just about looking back at past events. Auditors also have to look forward. This part of the job is called assessing the going concern. And it's basically like giving the company a physical, checking its vital signs to see if it's healthy enough to stay in business for the foreseeable future. The going concern assumption is absolutely fundamental to accounting. It just means that the financial statements are put together with the belief that the company isn't about to go bust. The foreseeable future is usually defined as at least 12 months from the company's year end. Now, if that assumption doesn't hold up, the entire basis for preparing the financial statements has to change. You go from a going concern basis to what's called a breakup basis, where all the assets are valued at whatever they could be sold for in a fire sale. So, how do auditors even spot this kind of trouble? Well, they're always on the lookout for warning signs just like these. We're talking about things like having more short-term debts than you have short-term assets, defaulting on your loans, or having to sell off major assets just to keep the lights on. Even losing a huge customer or a few key employees can be a serious red flag that puts the company's future in jeopardy. Each one of these is a potential symptom of a much deeper financial illness. And when those warning signs do appear, The auditor launches a really detailed investigation. They don't just take management's word that everything's okay. No, they scrutinize cash flow forecasts, they comb through loan agreements to see if any promises have been broken, they read the minutes of board meetings, listening for any whispers of financial trouble, and they even talk to the company's lawyers. It's a very methodical process to get a full, unbiased picture of the company's financial health. Okay, our third clue is a big one. It's a formal, signed document. After all the conversations and all the evidence gathering, the auditor needs something in writing, directly from management. This is what I like to call the signed confession, but its official name is a written representation. So what is it? Well, a written representation is a formal letter from the company's management to the auditor. And in this letter, management confirms a bunch of specific things and basically backs up other evidence the auditor has already found. It's an absolutely critical piece of the audit file. But, and this is a huge but, here is the crucial point, and it's a direct quote from the auditing standards. This letter is not a get-out-of-jail-free card for anyone. It supports other evidence, but it can never, ever replace it. An auditor can't just get a letter from management saying, yep, everything's fine, and call it a day. That representation has to be backed up by all the other audit work they've done. So what are they actually confirming? Management is formally going on the record to state that, yes, they've done their job in preparing the financial statements. They're also confirming that they've been an open book, giving the auditor access to everything, and they're acknowledging that any small errors that haven't been corrected are, in their opinion, not a big deal or immaterial. It's a formal way of them taking responsibility and confirming their transparency. So this leads to a pretty serious question. What if management just says no? Well, a refusal to sign is a massive red flag. It forces the auditor to question management's integrity and the reliability of basically all the other evidence they've provided. In a lot of cases, this is so severe that it can lead to something called a disclaimer of opinion, which pretty much means the auditor is saying, I can't form an opinion on these financial statements at all. And now we've reached the final stage. Taking all of these pieces, the subsequent events, the going concern assessment, the written representations, all of the detailed testing, and putting them all together to form the final audit opinion. This is what we call the overall review. The auditor essentially has to take a big step back from all the tiny details and look at the financial statements as a whole. Do they make sense? Are they consistent with everything the auditor has learned about this business over the past year? And do they follow all the required rules for presentation and disclosure? It really is a final sanity check. You know, throughout the entire audit, the auditor keeps this running list of any errors or misstatements they find, unless they're just completely tiny. They then have to present this list to management and ask them to make corrections. Now, if management refuses to fix some of these things, the auditor's final job is to figure out if these uncorrected errors, either by themselves or all added together, are significant enough or material enough to change their final opinion on the financial statement. And this just brings it all home. You can see here how each investigative thread we've talked about, the subsequent events, the going concern, the written reps, the final review of misstatements, they all feed into this one central process of completion and review. It's this whole web of interconnected procedures that all lead to one final destination, the audit report. So if you take one thing away from this, it's this. The end of an audit is not just a simple sign-off. It's a meticulous, comprehensive review that looks backward at events after the year end. It assesses the present financial health of the company, and it projects into the foreseeable future. It makes sure that the final report is built on a rock-solid foundation of evidence and very careful judgment. And that really leaves us with a final thought to chew on. When you consider the sheer depth of this final phase, the forward-looking assessments, the legal confirmations, the management attestations, what does it truly reveal about the value of an audit? It's pretty clear it's a whole lot more than just a history lesson on last year's numbers.